So let's start with the third edition of Kiln Rendezvous. That's how we call our day of panels. And we're going to start today with a very exciting panel talking about ETF, right? ETF is the new black since the beginning of the year.
The new black.
It's the new orange. New orange. Sorry.
Okay.
It's the new white. And we have to start Menno from VanEck, Jean-Marie, who's coming to the office for the first time from Coinshares, and Yoann from Wintermute. And yeah, I mean, it's I guess just a random thing that we have two French on this panel, but we also in Paris, and we have Glenn Brown as the moderator that will explain or ask questions to these wonderful guys about ETF. So thanks again for coming. I'm the CEO of Kiln. This is our office, and we welcome you for a nice day of panels. Let's start with the ETF panel, the new orange and not black.
Thanks very much, Laszlo. So as Laszlo said, we're here to talk about Ethereum ETPs and ETFs. But I think maybe just to get started, I mean, so Laszlo's already introduced these guys, but it would be great if you guys could maybe just introduce yourself and just a quick few lines about who you're working for, what you're doing.
Yeah.
Yep, what's up?
So, hi guys, my name is Menno Martens. I am a crypto product manager at VanEck. Before that, I worked at the central bank, the Dutch central bank. I was in crypto since 2016. After DNB, the Dutch central bank, I joined VanEck on the crypto journey.
Good. Hi, I'm Jean-Marie Mognetti. I'm the CEO and co-founder of Coinshares. Coinshares is Europe's largest digital asset manager. We manage around $7 billion for our clients. I joined crypto journey back in 2012-13 when we stopped doing commodities to do only crypto. And since then, we just keep building and make great people like the Kiln team and others on our way.
Yoann Turpin. I co-founded Wintermute in 2017. Got a past in sort of a macro hedge fund manager, essentially more in interest rates, and that kept me away from crypto in 2012 and 15, but finally said yes to the crypto journey in 2017. And then we've grown to basically be the largest spot crypto market maker, so we do 10 or 15% of the markets every day. I'm now based in Singapore to lead the Asian team to grow across Asia as such. And as one of the very few Frenchmen in the company, I'm just being sent to events as such. And full disclaimer, we invested to the point that we just wear their socks. So happy to be here, and hopefully you'll learn something.
Great, thanks guys. So the session's on Ethereum ETPs, but maybe we just quickly touch on the Bitcoin ETFs, because that's the hot topic at the moment. So we've had these Bitcoin ETFs launch in the US. They've been trading for about 3 months now, hugely successful. Probably beat a lot of, by all sort of metrics that maybe people were measuring the launch by. That they've exceeded, even taking into account the outflows from Grayscale. 10, 11 ETFs, $60 billion odd in assets. Just a general, very positive kind of thing for the space. But maybe before we go too deep into the ETF side of things, maybe for the audience who don't know exactly what ETFs are, maybe we can start there. So what is an ETF? And how does it bridge the gap between crypto and traditional finance? And maybe just taking that one step further. So we're talking about ETFs, which are in the US. In Europe, we don't have these single asset ETFs. We have ETPs and variations of that. So maybe what are the notable differences between these ETFs and then what we have in Europe? Maybe we'll start with you, Jean-Marie.
Sure. So Europe has been very fortunate because we managed to get this kind of crypto exposure since 2015. So if you think about it, it's pretty much 10 years jump start in Europe compared to the US, which make it a very different market compared to the US in terms of acceleration. When it comes to the structure, everything falls under the big family of ETP, so exchange traded product, and people then casually use different names interchangeably without really knowing the kind of key difference between them. So within the ETP family, you get the ETFs, the ETN, and the ETCs. The ETN is the simplest one. Well, ETN and ETCs are they're all securities, but some fall more on the debt side, and some on the AIF side, so the fund side. So that's different regime of regulation already in that sense. What we have in Europe is ETC and ETN. The ETC and ETN effectively are debt securities. You are facing, in the case of the ETN, the credit risk of the issuer. In the case of the ETC, which is exchange traded commodity just for single asset more than commodity specifically. You are facing effectively the issuer, which has a trustee on his board, and effectively all the assets are bankruptcy remote, so you are kind of de-risking yourself. So the ETN structure is very friendly for retail and kind of what retail likes. The ETC structure is, I would say, retail friendly too, but much more focused toward institutional. Now, when we come to ETF in Europe can be done for a single asset class, because ETF in Europe are very much aligned with MiFID and UCITS framework, which create this kind of diversification rules and so on and so forth. So the ETF framework in Europe don't really work, and ETC give effectively the right market penetration in terms of distribution that you want to get with a typical ETF as you know it in the US. Cross the border, swim to the US, and in the US, what do you have? You have ETF. And ETF is like what they are marketed at in the US. If you look at the prospectus, it's referred everywhere through exchange-traded product. Sometimes there is a trust reference as well, so it's very confusing. But to make it simple, it's like just a fund this time, and it's an asset on your balance sheet. So it's a very, very similar product. At the end of the day, what really matters is what kind of distribution network you're attracting, and are you able to distribute to the widest audience as possible for product. And an ETC in Europe and an ETN in Europe achieves the same distribution target as an ETF in the US, whilst an ETF in Europe won't be able to get you this result because of the rule around distribution of fund product in Europe. So in terms of outcome for the European market, what we have is absolutely fitted for the market. What Coinshares or VanEck has is absolutely fitted for the market. And in terms of what is happening in the US, ETF is the right go-to-market.
So talking about the success of the Bitcoin ETFs, or the launch of those ETFs, what do you guys think the major contributing factors to the success there, at least in those first couple of months? Maybe Menno, we'll start with you.
I think it's mostly the anticipation towards the event, because it's something that already was on the roadmap for a lot of people for a long time, since 2017 pretty much, 2016. That's approximately when we started doing things with crypto. We first started offering education on Bitcoin, on blockchain technology, other cryptos, and later we fell for the spot Bitcoin ETF in the US. So it's been something we've worked on a long time, and I think for many, let's say, conservative traditional investors, kind of the first ETF for an asset class is always kind of like a turning point. That's when the asset class is being taken more serious. It's being seen as a kind of a good part of, let's say, a balanced portfolio. And that's always what we've kind of advocated for, to include a Bitcoin or crypto as an asset class to balance portfolio. And now, through these kinds of products, even people without the technical skills for private key management and such, or for other reasons like not wanting to hold crypto directly on the balance sheet, it allows them to get exposure to crypto through regulated financial products.
So I agree and I disagree. I agree with the first part. I think the anticipation is really good. I think it builds up some expectation in terms of new adoption. I think there's more to come, because essentially, instead of us doing the marketing for the ecosystem, having Larry Fink, for example, that just goes on TV every day and just talks about tokenization in general and so on, is very, very helpful to get someone from the other side to just do the marketing for us. So I think that's a big thing. I absolutely agree on the abstraction factor. So essentially, if you abstract, a lot of people, if you look at on our side of Wintermute, we've done a lot of things in DeFi, for example, and that's a good way to represent the problem that people have between CeFi and DeFi, and people around the problems around crypto adoption, where people are really scared of holding their own funds and they're really scared of sending funds on chain, to either to lend or to transact. And if you can abstract that away, it's actually quite a big win. Yeah,
But to come back on the success of the ETF, you went from, that's the result of famine. There was no real good product in the US. So you get this massive draft at that point, which is like, okay, how do I get allocation? And all of a sudden you get 11 great products with massive franchise behind them and distribution network, because the distribution network of this, franchise is like nothing in crypto. I think the most grown up in that game in crypto in terms of traditional finance before that was VanEck. But the distribution network of a BlackRock or Fidelity is like another game in town. So you're just like right away opening your target addressable market in a very, very powerful way. The other part not to forget is like the crypto experience in the US is pretty poor. Like Yoann know that very well, because it's like everything outside of the US is working super well. Like Asia is a great market, Europe is a better market because of the offering you have. But like in the US, outside of Coinbase and Kraken or another few one, you're very out of anything tangible in terms of crypto experience. So it has been a lot of barrier to entry in the US, plus the political agenda, which is not always, whether you're Democrat or Republican, you get a lot of noise on both sides of the aisle. And then you get the regulatory agenda, which scare people away. So the ETF approval was really kind of a stamp of approval, despite the SEC making a statement saying it was not a stamp of approval. It really acted as a stamp of approval for a lot of people to say, okay, I can put a bit of my saving into it.
Yeah, I saw I saw an estimate the other day that the US wealth investment, or the wealth industry is around 40 to 50 trillion, and the estimate was about 30% of that now has access to these ETFs. So there's still and primarily because a lot of the platforms and intermediaries like Morgan Stanley, Wells Fargo, UBS haven't really jumped into it just yet, although that's happening. So I guess
never jump into it right away. There's always like a cooling period, like a warm-up period more than a cooling period, where you need to demonstrate a year of track record or 6 months of track record, depending on the provider, a minimum AUM level, and then they start doing the due diligence on the platform. So if you're a BlackRock, the due diligence is pretty much already done. If you are, a Bitwise or Coinshares, you need to restart from scratch with a Merrill Lynch or one of these guys, but that's fine. You just do the game. But so there's a kind of a push in the acceptation, which takes time. So the turnkey solution is there. Whether it permeates to all the layers takes a bit more time. So.
Yeah.
But Goldman Sachs Wealth is still putting that on, non-advisory. It's reverse solicitation only and this kind of stuff. So even houses which has massive franchise in-house building around crypto are still very, slow or disconnected when it comes to the wealth department doing their own homework and research. So it takes time.
Okay.
Yeah, it's not that smooth everywhere. So we've seen Korea, for example, basically ask the local brokers to not list the US ETFs. so normally they follow the US quite closely. So you can see, not all geographies are just following suit.
So the Bitcoin ETFs are largely structured in the same way. So we're talking about this generally commoditized exposure, I guess, to by wrapping the single asset for a price return. But Ether ETPs can offer something, can offer the same thing. They can track the price of ETH, but actually they can really differentiate themselves through additional yield. And there's different activities like staking, lending, perhaps. What's your take on this? Maybe, and what options are there for this additional yield generation?
Well, so we already cracked that little problem in Europe. So Coinshares has been the first one to stake ETH as an ETP back in, 2 years ago now, whenever it was starting to be able to be stakeable. Even if it was locked on one side, because the beginning was you can stake, but you can't unstake. So it was kind of an interesting journey. And then you have to say, okay, they're going to manage somehow to make it unstakeable. So it was a bit of when do we really start staking? Do we have a clear vision on the roadmap? And the consensus team and the Ethereum Foundation team has been very good at delivering that, but there was a lot of time at the time. Back in the days, we're like, okay, are they going to really be able to deliver that piece of the puzzle? And right now you can have a Coinshares ETP in Europe, which delivers zero management fees, and you share the staking reward with your investors on a daily basis. So people get their staking yield on a daily basis, and that gives them better return than they will get on by keeping their coin actually on Coinbase. So it's a very attractive proposal. Now the question now is like, how does that come to the US? Because the ETF discussion around Ethereum is really a US discussion now. I personally don't think it's going to be approved anytime this year. It's a very that's not really what people see on Bloomberg, but like the reality is like I don't see the SEC making a move this year for election. If an election happens, there will be other stuff to focus on than just focusing on an Ethereum ETF, and you probably get a change of SEC chair as well. The commissioner won't change, but the chair probably will change. So whether or not you have a change of administration, actually. So that's kind of one point. The question for the SEC then is like, okay, what is proof of stake versus proof of work? I think the proof of stake has been, well, I think they put a line in the sand saying, okay, proof of work we understand, or we seems to understand. Proof of stake, much bigger problem for us to put our heads around that. The reality is like if they approve Ethereum as a L1 and say, okay, then you open the gate for every single other L1. So I think they're kind of like working on this one with even more, I would say, due diligence or patience, or well, for us it's lack of patience, but for them we would say as patience, to make sure that it is done in a way which is justifiable. The next step of that is how do you handle the staking element and the staking component in the US? So it was very much unseen with the Bitcoin ETF, but the Bitcoin ETF was approved along with like a change in accounting rules in the US, which was not very much advertised, but which was a seller project for many, many months, if not years, which was hurting the balance sheet of US company having corporate Bitcoin. So you're going to have the same question around, okay, what are we doing with Ethereum? What are we doing with staking reward? Are the income? Are the capital gain? There's like plenty of questions which are being asked, which are the same thing as you saw in fixed income product as well. So a lot of work to be done, and when it's solved, then you can get to the market for the Ethereum staking ETF.
Yeah, I don't know if you wanted to go to.
Yeah, so maybe shortly about like the yield opportunities for ETPs, crypto ETPs. So here we've listened mostly to client demands and see the sentiment towards staking, and we noticed that like 1-2 years ago this was still very like negative, especially with regards to the whole Luna FTX drama that happened. So that, fair enough. I mean, it's a good reason, I think, especially when it comes from more conservative investors, traditional investors. I mean, in a way, crypto is already sort of a high-risk investment, and offering yield might scare them off. So we decided to wait with developing staking a bit. But as you may have seen, we started initiating staking actually as of last week, mostly because of the sentiment change towards it. So we are excited to see where other opportunities will bring us with staking and with yield-bearing solutions for ETPs.
Yeah, we're quite in agreement with Jean-Marie on. I think across the team, basically, we just think that there's less 50% chance that it will be approved in the next 3 to 6 months. And the general rationale is that essentially the CFTC is the only one on the record saying that basically it's ETH is a commodity as such, even if it was pre-proof of stake. And essentially there's no clear position from the SEC, and mostly everyone expects some form of litigation for a bit, still for ETH to be considered a commodity at the end, and if it's not, then we need to go back to scratch, because if it's a security, then people need to start again to apply for ETH ETFs as such. I think it's interesting on the points of like replicating yields and so on. Like for the ones who, as a sign up for the ones who don't know, like Coinshares takes about Coinbase takes about 15 to 25% of the staking rewards as such. So there will be some arbitrage there. So it's a good thing for you guys as such.
I know. Thank you. Right.
So it's just good to see. I mean, not everyone realizes that. I mentioned Coinbase again because essentially there's an interesting dynamic. Quite curious about what's going to happen on the ETF, on the ETH ETF side. But there's an interesting dynamic around Bitcoin Americanization, essentially. with most of the custody being done with Coinbase. I think it's only one of them that is with Bullish as such.
With BitGo as well.
And BitGo as well.
Yeah.
But essentially it's...
And VanEck is with Gemini.
Yeah, so it's very...
So, a bit diversified, but not so much diversified.
Not that much. But you get this interesting, like, re-centralization or Americanization of...
Yeah, but the funny stuff is, like, you saw it in mining already. Like, you remember when they banned mining in the US, and then it all flew to China, and then China banned it, it all come back to the US, and now the US are dominating the game. So,
exactly.
America is always very, very good at requalifying themselves, and, I think it's a Buffett quote saying, never short America. I think it was more true than ever when it comes to crypto.
Yeah, so we'll see if that happens because essentially Ethereum is actually quite decentralized as such. So we'll see how that is. The usual argument against an ETF is it can be manipulated, or it's not decentralized enough as such, and it's really not the case for Ethereum. Actually, it's quite there's a Coinbase report on this that's quite good. Where essentially ETH is much more liquid than most S&P stocks, and people don't necessarily realize that. But so optimism, but longer term.
So just because you raised it, I'm going to jump to another question which I had towards the end. So one question I had for right at the end was, so if we think about the fund infrastructure stack, maybe like the key, some of the, not all, but some of the key infra providers behind the funds, specifically around custody, market making, or LP, and maybe on the yield side staking. So obviously in the US we see this concentration of custodians right now. I'm sure that's going to change, but we don't seem to have that so much in Europe. Is there a reason for that? Is it just because of the time that's passed? We've had more time in the in this space.
I think there is a key misunderstanding in the US around qualified custodian concept, which doesn't really exist. It's a kind of invention we try to create, but like there is not such a thing. So, and it doesn't really apply for that specific. It exists in securities, but it doesn't really apply to a non-security. So if Bitcoin is not a security, then the qualified custodian concept is a much more difficult concept to grasp. When it comes to Coinbase, and I would say Gemini was on the ticket as well, and in another case, but you have to realize that it has been a very expensive experience to make it happen in the US, and the people who make a lot of money are the law firm. That if you were to look at the revenue of any crypto company doing an ETF right now, they are negative carry on the ETF because they spend way too much money since 2017 to make that profitable anytime soon. So when you try to minimize your cost and you realize that Coinbase has done all this work with the SEC already, you say, okay, well, I just put Coinbase for now, and everybody will be happy. So all the kind of provider it was almost like a silent argument. They all went with Coinbase because it was kind of the path of least resistance. To their defense, Coinbase has been doing a great job with the SEC for 5 or 6 years now, fighting every single step of the road to make sure it was the agenda was pushed properly at the SEC. So it was also kind of a right return of the investment. The Coinbase team during the launch to the ETF was extremely busy. I think there was like 200 people at Coinbase working on the launch, specifically because there was, they were just doing the custody, but they were also doing the trading. There was plenty of different pieces that were kind of like being interactive because the SEC moved to cash creation at the last minute, and the cash creation kind of like completely changed the whole operating model of this stuff, where all of a sudden the trust instrument has to start trading in crypto. So Coinbase say, okay, well, we can sort out this stuff for you guys right away. So it was an easy plug and play, and thanks God they were there, because you also need someone with a balance sheet to finance all this T+1 creation, which you don't have to do in the traditional model we have in Europe. So in short, yes, there's a big Americanization of the ETF market, as Yoann just mentioned. There's 15% of, I think the trading volume of the ETF right now is around 15 to 20% of the overall spot Bitcoin market. So it's still a big number, which is being traded now in the US. To some degree, a lot of hedge fund activity could migrate as well just to trade ETF, because there's plenty of arbitrage opportunity just there. And there's no need to start touching the coins or the underlying coins anymore. So it is a risk, but it's probably going to rebalance. And over time, you're going to see new service provider being added risk diversification, risk mitigation and diversification of risk being put in place around custodian, around things like this. But it's the next battle of the ACC to be able to just say, okay, how do we improve the diversity of service provider on the prospectus?
Mm-hmm.
Yeah, is your custody question more just specific to BTC and ETH in that case? Or because in Europe, so I can tell you for our experience, we did our own custody for many years because people, the copper, anyone else, Coiny at the time and so on, even Fireblocks and so on, no one was fast enough to call enough chains and enough coins and so on. So if you're entrepreneurial, you wanted to grow, you couldn't just use a specific custodian per se, at least in Europe. And I think it became more over time, the custodians that took over were more the custodians where you would cross-trade. So typically the Fireblocks of the world that have a certain network or BitGo and so on. So people it was more with the OTC market growing than really with C5 per se or D5 per se. It doesn't really translate into it doesn't necessarily impose a problem for ETFs as such. It's much more a regulatory question for ETFs as such, who's authorized to custody per se. But we'll see as it grows. It may come into play.
Cool. And so, if we think about the staking within the ETPs or a staking ETP, what are the key challenges there? I know you've touched on this already a little bit, but for example, the staking and the interrelationship between the redemptions from the fund and Ethereum staking queues. How do you guys kind of approach that? Maybe we start with you, Menno.
Yeah, so the regular Ethereum staking, it's more clear how to do that, right? So, but trying to scale that up to full potential, it's where the challenges start coming in, and that's mostly surrounding liquidity and being able to ensure that redemptions are still possible. So this is where we're looking at solutions like liquid staking, validator NFTs. We're closely following these developments. However, as much as we want to do that, it's completely up to the regulator to decide whether or not we can include these into something like an Ethereum ETN. So that's kind of the main roadblock right now. In order for us to scale up even more and offer more yield, it's enabling liquid staking, validator NFTs, which also have other benefits besides going beyond just liquidity. So that's what we're still working on closely, and it's a lot around kind of education. I think there's a lot of misunderstanding coming from the regulator. Speaking with them, they might not have the full picture of how it works technically. So we try to help in that, offering them documentation, meetings, whatever is necessary to get them on board with the idea of liquid staking.
All right, so if we go back to your question a little bit, to make sure everybody understands the problem here. The problem is the fund or the ETP have a daily creation and redemption window, so you have to be able to pay your customer at T+1 or T+2 in some case. Because the cash settle at T+2, not like crypto, which is at T0. So we effectively have a grace period of 2 days to find the money if your ETP was staked. So when the queue is 2 days, that's absolutely fine, everything works fine. And the queue is the time it takes to unstake your ETH from the network back into real ETH so as you can then liquidate to get real hard dollar cash. And that process, if it takes 2 days, absolutely fine. Now, the variation of the curve or the unstaking or staking queue, because you get queue on both directions actually, but the variation of that is a function of offer and demand on both sides. So the more people try to exit, the longer the queue. The more people try to enter, the longer the queue as well. So you get this kind of asynchronicity or asymmetry between the size of your queue on one side, which is this Ethereum specific network, and what you owe to your client, which is a daily liquidity. So the way we saw that Coinshare, and we were lucky enough to operate a very significant, prop trading desk, as well as our ETF business on the side. So our prop trading business is effectively the agent and the management team for the staking reward. So we can always find a way to just create and bridge that. If there was a liquidity bridge, we can always bridge it and make sure our client gets their money. So We are one of the rare people on our ETP market which are staking 100% because our capital market division can handle the rest and facilitate staking if the queue were to go in a different direction. And then we also managed to price that. The liquid staking issue, and last one I get a lot of discussion about that, it's all about, Yoann actually need to do his job now because it's all about the spread. Because it's all about the spread. The spread need to be good. So we need a good market maker to act in liquid staking so the liquid staking become a valid product because paying 2% slippage on $1 million worth of ETH is not acceptable. Well, for our clients it's acceptable. For us, the market is what it is, but we can't market that, say, okay, just lose some money on the spread. So over time, liquid staking is going to certainly get better and better, but liquid staking poses plenty of other solutions, which is it OFAC compliant? Is there some KYC? So I know Lido is a fantastic platform and did a lot of good stuff from the Ethereum point of view, brings that in an institutional framework much more difficult because of its own structure. Everybody can send ETH to the Lido network. There is no need to, okay, where are your ETH coming from, effectively question. So that's kind of not commingled very easily with what we try to do at an institutional level, but I'm sure there's solutions which are in the work. You mentioned NFT validator and all this kind of stuff, so plenty of stuff are in development, and hopefully there will be some progress in the future.
So can you reply?
It was a request. Now you need to make me a spread.
When are you doing the work?
Well, we do the best we can, really. So we build every day as such. I think that's one of the things that I try to communicate to everyone, which is we build this first before being traders. An analogy I like to use is that we're a bit like Google. No one thinks of Google as an advertising company, but they make money from advertising. We a tech firm as well, and we happen to make money from trading as such. A big issue we have nowadays is actually less about pricing and infrastructure. It's much more about financing. So the crypto US dollar is so expensive that the T+1, T+2 that Jean-Marie mentioned is actually very expensive to finance. And actually, if you're on the market making side, facing an ETF issuer and so on, which you participate in issuance and redemption, usually you need to basically give BlackRock and the likes, and so on, like a line of $100 to $300 million that you need to put on the side and basically say, we'll essentially park this, and it's quite expensive to people like us essentially. So
opportunity cost is expensive.
Opportunity cost is very expensive. So a firm like ours trades our own capital 5, 6 to 16 times a day. So imagine putting whatever $100 million on the side simply for the minimum bracket that an ETF issuer will ask you. That means that we would essentially just say no to 1.6, let's say up to $1.6 billion of volumes. So it is a big commitment. So I think there's a middle ground to find there, but on the liquid staking, it's interesting to see. I mean, there's other issues around re-staking.
Yeah, there's a lot of issues there.
Which is another question. I don't know how that gets reflected in ETFs per se. But yeah, I think the big elephant in the room is the cost of crypto US dollars, and I know some people linked with this conference and others are trying to get banks more involved and just to get more fluidity between the TradFi dollar and the crypto dollar as such. And but yeah, for people who don't necessarily know, it's to borrow USD in crypto, it costs 15-20% annualized or so. What it costs 4% essentially in TradFi. So there's an opportunity there. So we should we'll get it.
So someone told me today it's the most expensive capital in the world. Whether it is or not, I think they're making a point that what you guys are just talking about.
It is very expensive, and it creates a very, I would say, asymmetric competition landfill as well, because you get great firms like Wintermute, which has been created in 2017, 2016, which are not part of which are crypto native, for instance, so don't have access to any kind of TradFi financing or very little TradFi financing capacity compared to a Chicago market maker who has been doing it since, people forget, but most of these firms are 40 years old. It's very easy to say, oh, this German company is fantastic and this BlackRock is fantastic, but all these companies are 40 years old. Yeah. So we kind of children sitting on the shoulder of giants here, and we just need to make sure we grow with it. But for a company like Wintermute, they have to be extremely good traders to make money, because their return on investment, their break-even point, because the cost of capital is much more expensive than the break-even point for Jane Street or Gem. So it's a very interesting, the people who are pure crypto native have to be even better than the traditional firm because they don't have a cheap access to capital. So it reinforces the model.
Yeah, so we do find borrowers, but from family offices and so on. I'm still looking to borrow another $1 billion if you guys have it. Yeah, that's very good. It was worth coming here. But joke aside, it's very much, this disconnect is a reflection of so we're lucky enough to have made enough money in 2021. So we trade a lot on equity and so on. But I think that's an aspect that's not very good for the space post-ETF, which is that it means that, okay, there's a lot more liquidity constraints, there's a lot more needs to borrow. And that's obviously has been doubled by the fallouts of many lending platforms in 2022. So you have about $50 billion of potential lending that's essentially has gone away from the market in 2022. So that makes things a bit less efficient and it makes things less competitive. So we're in a good position where we grew before and now we can still compete as such. But it makes it really hard for new entrants and we always greet new entrants and just we want to have more good competitors as such to help Jean-Marie and get tighter spreads and liquid staking.
Well, Yoann is not to be. We don't cry for you. You just say you're looking for another $1 billion. So you already have a couple lined up. So it's not like you like. So just another $1 billion.
That's true.
I think we could talk about this for a very long time, but I'm getting in trouble because I'm bumping up against time. So maybe we just want to have a couple of questions. Sorry, Adam, I know we're over time, but just a few questions, and then we should probably. Sorry, we'll come back in there.
Hi, thanks for the talk.
No more questions.
The microphone.
Oh,
there's a mic.
Oh, yeah, it's over there.
Super.
Don't think it works, does it?
It's just a record.
Okay. Thank you for the talk.
For the compliance team.
Sorry?
For compliance team.
No pressure.
Jerome?
You said it, the launch of the Bitcoin ETF in the US has been a great success. It has been existing in Europe for a long time, but we haven't really seen the same traction. According to you, what are the main barriers and what prevents Europe from gaining the same level of success in the US?
I don't think your statement is true, actually. I think the European market is by default on the ETF side 15 times smaller than the American market. If you look at the total AUM in Europe versus the total AUM in the US, there is still a lot to grow in the US, funny enough, just on these basic metrics. So the European market has been open for 10 years as well already. So the accumulation has been done very slowly over the years, not in just like a window of 4 weeks. So it's true that BlackRock did a very good job. They did in 1 month what Coinshares did in 10 years. So I can't really say they are not much better than us, but that's the truth. It's just like a massive distribution network and a massive machine. And you just need to go to the office to realize a different universe and that you are just eating some humble pie just looking at that. But overall, the European market has been a very big success, and it's still a very big success. The amount of outflow from Europe has been very tiny, so which proves the point that the products don't travel very well, and people allocating in Europe are not looking to allocate outside of Europe. So European products are built for European investors, and American products for American investors, and kind of Latam or Asia. So this kind of key principle and core value of the ETF distribution network still hold in crypto, and if anything, we're probably going to see more adoption coming in Europe from plenty of pockets where you don't allocate. Think about life insurance. Life insurance can allocate to crypto right now, or at least crypto ETPs. They're just not doing it because they were waiting for MiCA and some kind of regulation, especially post FTX. So you get plenty of pockets which are not open. If you look at the policy of banks in Europe, you talk to some French bank, we're not going to make any names, they have a very powerful distribution network of their own, while they refuse to list any ETF which is not their own brand. So unless they launch something or partner with someone, they're not going to do it. So in Europe, there's really been the independent network. France has been the kind of, France is a very different model of investment into crypto, which is mainly happening through traditional platform, like crypto traditional platform, not through kind of ETPs or ETF, just because French investors are mainly real estate investors. They don't really have the kind of self-investment of their own retirement plan. The welfare state in France make sure that nobody needs to trade. The state is trading for you, with pro and cons. But like a German retirement candidate will be much more active in how he allocates his own money for his retirement plan. So the culture in Europe is very different as well. You're targeting a market which is very fragmented, very different culture of investment through Europe, very different language as well. So this entire journey make it much more difficult to penetrate Europe as it is the US. The US is one big market. People kind of allocate the same way whether you speak in San Francisco or New York, and they're all looking at making money. So the narrative is very, very simpler, or much simpler than it is in Europe, where you have to play different kind of narrative, whether you speak to an Italian or a British investor. And don't forget the LSE is still closed, which is one of the biggest markets in Europe, and the Borsa Italiana is still closed, which is also one of the biggest ETF markets in Europe. So while these two markets remain closed, you still have a lot of potential growth, which is still non-allocating and waiting for basically dry powder on the side.
Thank you.
Maybe just one more question, and then we can stop. I think there's one here.
So you talked a bit about Ethereum staking for ETF and rewards, yield opportunities that you can make, I guess, for the ETF to do revenue and for the user, the day, the moments already happening in Europe, you can pass by the rewards. Do you see similar opportunities in Bitcoin? Rewards, yield, is it lending? Is it Bitcoin staking for ETF?
So Bitcoin lending for ETF is not very... for VanEck vehicle, which are ETN, you can do lending. You can do lending as part of it if they decide to do so. So to create some yield there. For ETC structure, which are bankruptcy remote structure, and if they are set up properly, every series is dependent from each other, so there is no cross-contamination if one series go bankrupt. So it's really, really segregated sale in itself. There is no capacity for lending, so lending is not an option. Now, if there was staking or some kind of staking discussion which are happening right now around Bitcoin, whether it is Lightning, whether it is other kind of Babel or whatever kind of setup we were discussing, it's a lot of, right now it's still very, very alchemy word. The question is like, are we able to build it into something which is transparent enough and we can sell and explain to the regulators, then there is potential there as well. But so far, nothing tangible, but a lot of discussion, obviously.
Do you think it could happen one day?
Well, I'm not part of the development team at Bitcoin and any of this, but like if there is a good case, we'll definitely push for it. If we can be comfortable enough that the smart contract infrastructure is solid enough and robust enough to not put our client at risk with this kind of extra yield, because at the end of the day, it's like, do you care making another 1 or 2% for a kind of return on investment which you don't know, your potential loss can be zero. It can be effectively all your investment. The risk reward is not really great. So it's a question of like, what is the risk reward and how comfortable can we be in the smart contract technology, which will underpin that new staking on Bitcoin, if it ever exists. But I know there is a lot of discussion about that.
Yeah, as much as there's expensive crypto USD, it's fairly cheap to borrow Bitcoin. Like it just costs whatever 2-3%. So the risk reward is quite different.
Bitcoin is mispriced anyway. Like the borrow rate of Bitcoin is definitely mispriced. It's way too cheap versus the risk you're taking, especially if it's I don't know if it's 2-3% collateralized or uncollateralized.
I'm assuming it's just all the miners uncollateralized. It's just miners who just wants to borrow dollars against it. They just tend to stake, or not to stake it, but to collateralize the Bitcoin for USD. So yeah, it's a different market. But with the L2s, there may be something funny with stacks or some of the other L2s at Alex or so. That may generate a lot more yield. I'm not too sure.
Great. I think we're actually over time. So guys, thank you very much.
Thank you for having us.